aim of this lesson is to learn about the statement of profit or loss. The learning goals are for you to be able to explain its purpose, identify business income and business expenses, and calculate gross and net profit. In the previous lesson, we very briefly identified two important financial statements that are related to the double entry bookkeeping system. The statement of profit or loss shows whether the business made a profit or loss during a period of trading. They're produced at least annually for external reporting, but can be produced for managers to cover any period of time. The statement of financial position shows the financial structure and health of a business at a certain point in time, what's been invested and borrowed, and how it's been used. Both of these financial statements are connected to the double entry bookkeeping system. In this lesson, we are going to focus on learning about the statement of profit or loss. The statement of profit or loss is the easiest financial statement to understand, as we simply deduct the business's expenses from its income to calculate profit or loss. Profit is earned when the income is greater than the business's expenses, and a loss occurs when the expenses exceed income. The production of financial statements is highly regulated to ensure companies do not mislead us and to help us to be able to compare the financial statements of multiple companies. The rules a business adopts or is required to follow will depend on where it's located and where it trades. Accounting rules might differ slightly, but generally they all follow the same principles. We'll not focus on specific rules, but we will be learning about the general principles. For us to be able to accurately process transactions in the double entry bookkeeping system, we need to be able to identify the business's income and expenses, and those that are permitted to be recorded in the statement of profit or loss. Let us start with income. Income is the revenue earned from the ordinary profit-making activities of a business. The bulk of a business's revenue comes from its trade, the sale of its goods and services. But sometimes there are other types of income, such as interest received, perhaps from bank deposits, commissions and royalties, amounts paid by someone else, perhaps for promoting or selling their products, and dividends. This is income that can be received as a return on an investment in other businesses. The statement of profit or loss begins with recording the total amount of income earned during a period of trading. The figures are taken from income accounts in the double entry bookkeeping system. They are used to record income as it's earned. At the end of a trading period, the total is calculated and the figure is recorded in the statement of profit or loss. We will be learning about how to use these accounts later in the course. To avoid bookkeeping errors, it's essential that we can correctly identify income, because cash flows into the business in other ways too, but not all cash inflows are recorded as income. For example, a sole trader may invest more cash into the business, or they may receive a bank loan, or receive money for selling something of value that the business owns. These types of transactions are not ordinary, everyday profit-making activities, so they cannot be recorded as income in the statement of profit or loss. Now it's time for a question. Please pause the slide, read and answer the question, and press play once you're ready to listen to the answer. To identify income, ask yourself, what does a hairdresser do most days to make a profit? They style hair, rent chairs out to other stylists, earn commission from product sales, and maybe earn some interest on bank deposits. The other transactions cause cash to flow into the business, but they're not everyday ordinary profit-making activities, so they are recorded differently. The business's profit-making activity causes expenses to occur, and to calculate profit, the costs are deducted from the revenue earned in the same period. There are many different types of expenses, but typically they include the cost of purchasing materials to make products or purchasing stock to sell to customers, the costs associated with running a shop, office, or factory, the cost of employing people, as well as advertising, marketing, selling, and distribution costs. In the bookkeeping system, a business can group together different expenses in a way that's most useful for them. For example, some businesses may want to monitor the costs for gas and electricity separately, so they'll have one account for gas and another for electricity. Yet, another business may put all the costs in one energy costs account. Cash flows out of the business in other ways too, and again, to avoid bookkeeping errors, we need to be able to identify transactions that are not related to the business's ordinary, everyday profit-making activities, as they are accounted for differently. Examples are a sole trader withdrawing capital that's from their initial investment, or taking drawings. If you recall from an earlier presentation, there's no separation between a sole trader and their business. They are not employees. So when they draw cash from the business, they are drawing from the business's profit or the business's capital. These types of transactions are not recognised as business expenses. When the business buys an asset, that's a valuable item that will be used in the business over a number of years, for example, purchasing new machinery, the whole cost is not recorded in the statement of profit or loss at the time of purchase. Neither is the repayment of loan capital. The accounting for these types of transactions is a little more complicated, and you'll learn about it at advanced levels. It's time for a question again. Please pause the slide, read the question, and press play once you're ready to listen to the answer. All of the highlighted costs are incurred by the everyday operating activities of the business. The owner taking cash from the business is not a business expense, as they're drawing from the business's profits. When a business invests in valuable equipment and intends to use it for a number of years, the whole cost is not recognised as an expense at the time of purchase. It's accounted for differently. The repayment of loan capital is also not recorded as a business expense. To summarise, for you to be able to process transactions accurately in a double entry bookkeeping system, you need to be able to identify the income and expenses that are permitted to be recorded in the statement of profit or loss. If transactions are not classified and recorded in the bookkeeping system correctly, the data in the financial statements will be misrepresented and cannot be relied upon. When learning about double entry, you don't need to be able to do profit calculations, but for completeness, we will take a look at a very simple example. The first line of a statement of profit or loss records the business's sales. From sales, we deduct cost of sales. This is what it has cost the business to make or buy the product or provide a service to the customer. For example, a car manufacturer builds cars, so the cost of building the car is the cost of sale. A supermarket sells produce, so for a supermarket, the cost of sale is what they've paid for the produce. A hairdresser cuts hair, so the cost of hands-on labour could be included as a cost of sale. Cost of sale does not include the general running costs or overheads of the business. So gross profit is what the business has earned after cost of sales has been deducted. Please pause the slide, read the question and press play when you're ready to listen to the answer. The clothes shop earns its income by selling clothes. The cost of sale includes the cost of buying the clothes they're selling. The bakery earns income from selling baked goods. The cost of sale will include the cost of the ingredients bought to make the baked goods. And a dog walking service earns its income from walking dogs. The cost of sale could include the cost of hands-on labour, so that's the wages of the actual dog walkers. To calculate net profit, we deduct other business expenses, which are also known as overheads. There could be a large list of overheads. We've just included a few to keep it simple. So net profit is the profit made after all business expenses have been deducted. Net profit can also be described as profit for the year. If you haven't done already, pause the slide and make some notes to help you complete the next activity. Pause the video, read the question and press play when you're ready to review the answer. To calculate gross profit, we deduct the cost of the ingredients for making the cakes from the revenue earned from the cakes we've sold. We ignore the bank loan as it's not a profit-making activity. To calculate net profit, we deduct the shop's overheads and employees' wages and salaries. We ignore the owner's drawings and the loan capital repayment as they are not business expenses. I hope you've enjoyed learning about the statement of profit or loss. In the next lesson, we'll be learning about the statement of financial position.